Your retirement plan assumes the market will occasionally drop, but the math becomes dangerous when a drawdown aligns with a sudden spike in spending. Most early retirement projections rely on a static baseline. They take what you spend today and extend that exact burn rate out for the next 40 years. But life stages aren't static. A single tech worker renting an apartment can live on a fraction of the cost to support a family. As your life grows more complex, your baseline shifts from discretionary choices to rigid fixed costs. An 8-figure net worth seems substantial until you commit $3 million to a primary residence and $90,000 a year to childcare. By locking up capital in a house while doubling your annual burn, you are asking a much smaller liquid portfolio to generate twice the yield. Funding the life you have now is the baseline. The real test is whether an allocation can fund your future life without creating structural fragility. To understand the mechanism of failure, we have to compare two different models of post-retirement spending. On the left is the spreadsheet model, a steady, predictable 4% annual withdrawal line that never changes. The right side shows the life stage model tracking reality. Here, massive capital requirements appear as you outgrow your lifestyle. A $2 million home in year 3, and 6-figure childcare in year 5. If the market drops 40% simultaneously, the safe withdrawal rate breaks down. This is sequence of returns risk. You're forced to liquidate a larger percentage of your remaining shares to pay for fixed costs, precisely while those shares are at their lowest valuation. Lifestyle upgrades are a legitimate use of capital, but executing them during an early market downturn can deplete a portfolio's principal so severely that it never fully recovers. Consider the first major upgrade, moving from a starter condo to a 3-bedroom house in a high-cost city. This usually requires a 7-figure down payment, liquidating stocks that would otherwise be compounding. It also increases your annual floor for property taxes, insurance, and maintenance by $50,000 to $100,000. We mapped this choice on a risk matrix. The vertical axis is fixed cost burden. The horizontal is vulnerability to a market crash. A large primary residence plots high on both, creating a massive liquidity lockup. You are trading liquid shares for a physical roof. That limits your ability to reduce spending if your investment portfolio takes a hit. While a home provides personal utility, the sheer volume of cash it requires makes the rest of your portfolio more sensitive to market timing. The second major upgrade is often premium childcare. Hiring a full-time nanny, including payroll taxes and healthcare, can cost $90,000 a year. When you add nursery school, your annual withdrawal rate can easily move toward the danger zone of 5 or 6%. On our matrix, childcare sits lower on long-term risk because it's temporary, but its immediate sequence risk is extreme. It is a pure sunk cost, requiring you to sell shares every month to meet payroll, even if they are down. The value here is time. You are buying back 40 hours a week so you can actually engage with the retirement you spent years building. The paradox is that this specific purchase of time forces your capital to work much harder at the exact moment it is most vulnerable. Then there is the cost of the time itself. Transitioning from a 50-hour work week to retirement leaves you with 50 hours of empty time to fill with hobbies and travel. Travel can be expensive, but it is a flexible cost. If the market dips, you can cancel a trip or stay closer to home. You have full control over that lever. You do not have that same control over your healthcare costs once you leave a corporate plan. A private plan for a family of 4 can cost $5,000 a month in premiums alone. When you factor in deductibles and out-of-pocket maximums, you're looking at a $60,000 annual floor that cannot be negotiated. Travel plots high on cost but low on sequence risk because it's optional. Healthcare, however, plots high on cost and high on fixed burden because it is mandatory. Managing a market crash depends on your ability to distinguish between your flexible upgrades and your permanent spending floors. Most investors facing these risks fall into one of two categories: the frugal forecaster or the established family. The frugal forecaster often models their retirement on a low single-person burn rate, despite plans to start a family later. If you're in this position, don't retire until you model a 40% drawdown against the cost of your future life, not your current one. The established family usually has the net worth they need, but they are often 100% invested in equities, while carrying $400,000 in annual fixed costs. For this group, the priority is insulation. You must trade some upside for 2 to 3 years of cash or bonds to protect your fixed spending from market volatility. Both groups need an anti-fragile allocation. This means designing a portfolio that prioritizes your ability to stay the course over achieving peak mathematical efficiency. You can stress test your own plan using 3 specific criteria. First, have you modeled a 40% market drawdown using your projected future costs rather than your current budget? Second, have you capped your exposure to concentrated employer stock to avoid a single point of failure? Third, do you hold at least 2 years of your mandatory fixed costs in liquid, safe assets like bonds or cash? Retirement planning is about preserving your optionality. A resilient strategy ensures that a bad year in the market never forces you into a permanent downgrade of the lifestyle you work to achieve.